Of course, the topic for our presentation today is 3 costly retirement and estate planning mistakes and how to fix them, certainly for educational purposes, but we do have a lot of good material. So hopefully you'll walk away with some practical information. Now, before we get started, just to get a couple of admin items out of the way, this webinar will be recorded, but none of your personal information will be in the final recording, so no worries about that. We certainly encourage you to ask your questions in the chat box. Please type them at any time. If it's related to what we're discussing at the time, we'll just address it right away. If it requires more of a detailed answer, perhaps we'll wait until the end of the presentation. We'll have a Q&A session at the end. For any of you who ever participated in, financial planning or investment webinars, I have to quickly read you this disclaimer. Nothing in this webinar should be considered any kind of investment or financial advice. The information that we're about to share with you is purely for informational and educational purposes, even though, again, I very much hope that you'll find it practical. If you decide to implement any of it, we strongly recommend that you consult with a qualified professional or, of course, do your own due diligence. So with that out of the way, of course, I always look at the list of participants in our webinars. So for the one we're about to have, roughly 50%, roughly half are our clients, existing clients. Of course, welcome. It's great to have you with us. The remaining half are people I know, maybe I don't know them that much, or at least perhaps they don't know me that well. So for those of you who don't know me yet, my name is Alex Seleznev. I'm the founder and financial planner, Capital Squared Financial. We're a boutique style firm in Maryland, and our focus is specifically on retirement and multi-generational planning. That is almost exclusively all we do. We're very proactive when it comes to tax planning. That is frequently one of the primary reasons why many of our new clients reach out to us. In terms of our investment strategy, we manage investments for our clients in-house, and everyone has a personalized strategy. So there are no cookie cutter models. As a firm, I've been around for almost 2.5 years at this point, but I've been working with many of my clients for over a decade. We've been growing quite a bit. We now serve over 70 families in 13 different states and actually 4 different countries. And we manage a bit over 170 million for them. We always serve as a fiduciary when we work with our clients. We're a fee-only firm. We're fully independent, and we certainly plan to remain, operating this way, essentially, perpetually. Of course, if you want to learn more, feel free to reach out to myself or visit our website. My co-presenter, Megan Campbell. I've known Megan for a long time now. We've done many joint events, and she's great. And we also have many mutual clients. Megan, would you like to introduce yourself?
Well, Alex, thank you so much for having me here. And hello, everybody. Thanks for joining us. My name is Megan Campbell, and I am the founding partner and senior attorney for Willow Legal Group. All we focus on is estate planning and estate administration and elder law, which includes long-term care and Medicaid planning. Estate planning, I work with so many clients to see how this plan affects them, not only them as individuals, but their families. And so putting in place a plan and making sure there is something there so you don't leave your family with a mess to clean up, either in a time of crisis or when someone's passed. So I'm excited to be here today. Thanks, Alex.
Thank you, Megan. Now, for any of you who ever participated in our previous webinars or seminars, actually, I usually try to start with some kind of quote, in the context of what we're about to discuss. Sometimes it's funny, sometimes not so much, but there's something to be said about this one. Experience is simply the name we give our mistakes. And I'm sure everyone heard, all of us are learning from our own mistakes. But in terms of our webinar today, again, we're going to be sharing some of the top, mistakes that people make in their retirement journey, and of course in the estate planning side, certainly very much hope that you will learn from other people's mistakes and you're not gonna make them yourself. So we'll start on the financial planning side first. And perhaps this is one of the most common mistakes. And sometimes people do not even realize that they're making it, and there are reasons behind that. But this one is specifically when people invest too conservatively, in the early years of their retirement, perhaps 1 to 2 years prior to their projected retirement date, or when they first retire. Now, there's some logic behind that. There are lots of rules of thumb. You're in your mid 60s now. You cannot assume that much risk, and your portfolio should have much less in stocks. And some of that is certainly true. And by any means, I'm not trying to make a point that someone in his or her 60s or 70s should be investing like a 30-year-old. But the issue is when someone is going overboard. And I'll tell you, just this year we had three new clients. They came to us with rather sizable portfolios, actually, but most of what they had was in cash and bonds. And of course, the most recent market turbulence had something to do with that. But still, when you're building someone's 20 to 30-year plan, you have to be very careful. So what are some of the potential issues with this mistake? Well, there's this false sense of security. And so here's what I mean by that. It's nice, when the markets are down, and let's say you look at your portfolio and it remains mostly flat, or maybe it's down by a little bit. But in reality, in the long run, your biggest enemy, I'll put it that way, is inflation. It's not so much market turbulence. So when we start talking about, again, early retirement, in the mid 60s, maybe early 70s, that's when you really want to account for the so-called longevity risk, or essentially the possibility of outliving your own money. And if you invest too conservatively, well, it essentially increases the chance that that will happen. Now, the other big issue here, and again, that's specifically for younger retirees, is usually this approach fails to account for long-term care expenses because, well, usually, not always, but usually they come later in life. And as I'm sure everyone will agree, they can be rather significant. So again, you have to be careful even from that perspective. So just to give you a simple example here, this again, a very simple example, not meant to be, detailed analysis or anything like that. But let's say that you've determined that you need, $1 million for your long-term care expenses 20 years down the road. Now, if you invest your funds in a more balanced approach, balanced allocation with a rate of return of 7%, you essentially need to, quote unquote, set aside $180,000 today to pre-fund your expenses. Again, there are other details behind it too, but I'm just giving you a simple explanation. Now, if you prefer to invest very conservatively and your projected rate of return is only 4%, well, now you need to set aside $330,000, which is almost double of the amount if you're investing, again, in a more balanced way. And of course, all of this is magnified because there are other expenses too. There's a potential inheritance that can be important to you. So again, this can be a big issue in the beginning of your retirement. Well, how do you fix this? And I'll probably say this multiple times today. Well, you need to have a plan in place. And instead of focusing on your age, and all of us know your age is just a number, you really need to focus on your circumstances. I'll start with the basics here. Well, how much do you actually need from your portfolio each year? And you need to know that. You have your budget, you have your projected expenses. Do you need a few $1,000s? Do you need several, or is more significant amount? But you need to understand that. What is your portfolio size? That's an important factor too. And I know it's sometimes on the surface, but let's say you do have a significant amount and your projected cash needs are relatively limited because you have your Social Security, perhaps you have your pension income, let's say you're a federal employee. Well, just from that perspective, you don't necessarily need to be that conservative. Again, perhaps you would prefer to invest that way, but you don't have to. What is your long-term care plan? in our today's presentation, we're not going to dive into that much, but I'll just say that many of our existing clients, and something tells me that many of our new clients will be in a position where they essentially have to self-fund it. And it's important to have a reasonable, projected rate of return for that to actually happen. And of course, perhaps one of the most important factors, sometimes I even start our conversations with that, what is your history of longevity? What health condition are you in? And if someone tells me, well, you know what, Alex, I'm about to retire and I'm in my, mid 60s, both of my parents, let's say they're still alive and they're in their late 80s. Well, that immediately tells me that for this particular person or perhaps for this particular family, we really need to stretch their existing dollars for the next 20, 30, potentially even 40 years. And that's a long time. There are two ways to handle it from the investment perspective. There's a traditional approach, which I assume many of you are familiar with. That is essentially when you do the analysis and then you come up with a split between stocks and bonds. Of course, it can be other types of investments. Then there's our preferred approach. That's our specialty at Capital Squared, which is when we create we call it a fortress financial plan. And essentially the way it works, doesn't work for everyone, but when it works really well. The idea is to essentially replace 70 to 80, sometimes even up to 100% of your expenses from the income your portfolio generates. And it's easier said than done, but in practice, especially in times of market turbulence, it really, in some sense limits or even prevents any need to touch the principal value of your portfolio. Again, this can be very valuable to young retirees specifically. Moving on here, so I'll tell you when I've done different types of seminars in person, and I would ask this question: what do you think your largest expense in retirement is going to be? Or question along those lines. And if you want to answer, feel free to do so. But usually there would be at least a couple of people who would raise their hand and they would say medical expenses. That's usually the most common response. And it's true. And usually later in someone's retirement, in someone's life, again, long-term care is pricey, and your overall health condition perhaps begins to decline a bit. So yes, medical expenses can be quite large. But throughout your retirement, and specifically in the beginning, during the so-called go-go years, when you're trying to cross different things off your bucket list, that is when your taxes can be quite significant, and you need to have a plan to reduce them. Now, to make it clear, there's usually not possible to eliminate them, because I know there's some financial advisors suggesting that usually it's not really possible, but there needs to be a plan to at least reduce them. So what I wanted to demonstrate here is essentially the worst type of plan, something that you really don't want to be doing. But I'll tell you, in practice, especially when we work with some of our newer clients who have been managing their own finances, sometimes reasonably well, but they just kind of miss on these important points. Well, the first one is, of course, you need to understand when your required minimum distributions are going to begin. Again, just in case you're less familiar, at the age of 73, you must take out the portion of your IRA, 401k, 403b account, essentially 4% or so, and you have to pay taxes. There are some circumstances when that's not necessary, but for most people, that's the case. It can be a rather significant amount, as you can imagine, if you've been saving for the past 30, 40 years. So you need to be aware of what that is. And if you have time, preferably 5, 7, or 10 years, what is it that you can do to reduce that future tax burden? The other common one is when people essentially use all of their brokerage or taxable accounts first. And it can be logical and can actually work very well when someone says, let's say, 50% of my assets are in my brokerage account, 50% is in my IRA. I'm just going to draw from my brokerage account for the next 5, 7 years, and then when I turn 73, I'm just gonna switch to my required minimum distributions. That can work very well, but it's not always the best, because if you're in a lower tax bracket, in the beginning of your retirement, it can be very beneficial for you to actually take some funds out of your, I'm just going to say IRA accounts. It can be a 401k or 403b. It can really make a big difference in the long run. The third one, again, very, very common on the retail side, is lack of portfolio planning. I'm not talking about, how much you have in your stocks, in your bonds. That's a separate issue, but specifically where you keep different funds. What happens very frequently, people keep tax inefficient investments in their taxable accounts, so they pay more than needed essentially each year, and they keep more tax efficient investments like growth funds in their IRA accounts where they don't pay any taxes up until they make distributions. Very frequently you would want to do it in reverse. Again, it's more of a technical point, but it's one of those invisible mistakes that people are not even aware of. And then finally, which can certainly be situational, specifically when you have a negative year, strategies such as capital loss harvesting can be very beneficial, but unless you're, monitoring your portfolio more or less actively, it can be hard for you to do that. There's also the idea of capital gain harvesting, especially in year 3 of the existing bull market. And that can work very well, again, for those in lower tax brackets. You can end up in a situation when you don't pay any capital gains tax. It's very situational, wouldn't work for most people, most likely. But again, if you're on top of it, it can be beneficial to you. So what's the fix here? Again, you need to have a plan. I'm saying this for the second time today. And usually when you discuss someone's distribution strategy, you split it in 2 periods. It can be 3, it can be 4. Let's say if someone works part-time, post-retirement, so to speak, so there adds an extra period. How are you going to draw from your accounts prior to your age 73 or your RMD age, and what's going to happen beyond that point? And as I mentioned earlier, frequently, not always, but a combination of distributions from your taxable and IRA accounts can be more beneficial for you in both short and long term than simply waiting and draining your brokerage accounts. Multi-year Roth conversions. Again, if we're doing this in person, ask for you to raise your hand if you ever heard about it. Something tells me everyone heard about it. Of course, it's one of the most popular strategies to reduce or potentially reduce your taxes in retirement. I'll tell you up front, we do this analysis, if not in a weekly, then very many times each year. It doesn't work for everyone. This is not a no-brainer type of deal. Not everyone needs to be doing it. It can work very well for some people, but not necessarily for everyone. Now, here's a couple of things for you to be aware of. Let's say you're early retiree. Usually that means early 60s, late 50s, and you have multiple years. I refer to them as artificially low income years. Let's say you do live off your income that your portfolio generates. There's no Social Security, there's no RMD yet. Well, perhaps that creates an opportunity for you to convert in a lower tax bracket. Legacy planning is actually a big deal. Like I'll tell you, many of our clients do it for that reason specifically. And what I mean by that, let's say you do a conversion in your mid 60s as an example, and hopefully around for the next 30 years or so. So any growth that you capture in your Roth IRA account, of course, benefits you, but then it also benefits the next generation, let's say your children, because if your children inherit your Roth IRA, they do have to distribute the funds in 10 years, but then there are no taxes to pay. So now we're stretching it. So now you pay taxes once for both generations. Again, that can be a very useful tool also as part of your overall estate plan. And maybe, Megan, you'll touch on that a bit. And then finally, the third point, I was reluctant to include it here, but when the markets are down, like what we had in April, when the markets are down, and you can do it opportunistically, right? So then the markets begin to recover at some point down the road, then your recovery is essentially captured. Any growth post-recovery is captured in your Roth IRA. That can be beneficial too, but this is not something you can necessarily plan for. You just need to do it. You just need to be prepared to do it when the time comes. So the third and most likely the biggest mistake that can, and I'm not being overly dramatic here, but this can really ruin your overall financial plan, regardless if it's tax efficient or tax inefficient, is reacting emotionally to the markets. And I'll tell you from experience, this is usually one of the biggest issues for young retirees, people who are about to retire, recently retired, and it has to do with, of course, behavioral finance. Now, I have a feeling many of you perhaps can put yourself in those shoes. You've been saving your whole life, 20, 30, 40 years. You've accumulated significant funds. Then, we're not going to make this political, but someone puts a social media post, and your portfolio is now down by a significant percentage, just like what happened in April. See, you need to have a plan for that, and you need to stress test your existing plan. Now, again, there's lots of data on the subject. Perhaps, again, you've heard about it. I'm not necessarily quoting anything specific here, but if you somehow, some way miss the top, best trading days over the past 20 years, well, that reduces your total return by 50%, or essentially in half. And that's a very significant percentage. And also the next point is perhaps a bit counterintuitive to some, but at this stage, I'm just going to say mid 60s and beyond, it's going to be challenging for you to replenish. See, if someone panics in their 40s or 50s and they still have, 7, 10 years of additional contributions, perhaps they're going to be fine. But for someone in that situation who no longer plans to work, that is essentially a permanent loss. And I very much want you to be aware of that. So here's an example, and this is, by the way, a real example. Of course, I simplified it, but it happened, 6 months ago. Of course, post quote-unquote Liberation Day in April, when the markets were down by 11%. There was lots of uncertainty, to put it gently. And if you panic sold, well, we know this in retrospect, you of course missed out on a pretty significant rebound by over 30%. It's actually closer to 40 at this point. We had clients, earlier this year, they were interested in our planning services, but they decided to manage their funds on their own. So they sold. That's the bottom line. They sold, they just couldn't tolerate it, essentially. Then, of course, the markets pretty much recovered. We got in touch, they reinvested. They will actually be in good shape going forward. The bottom line is we actually did some rather simple math. That, decision, that emotional decision, resulted in a permanent loss of $240,000. And something tells me, again, many of you, they're aware of this, perhaps your own situation, 2007, 2008, year 2020, right? COVID year. I don't want to remind people about it, but that's when the markets were down by 31% in 17 calendar days. So unless you have a clear understanding of what you're going to do in that situation, there's a pretty strong probability that you will panic and you'll sell at exactly the wrong time. So how to fix this particular issue? Well, again, I'm saying this for the third time now. You need to make a plan. You need to make a plan. Like now would be a good time. The market's pretty much fully recovered. And then you need to stick to it, which is easier said than done. And we know it. One thing that helps some people, and just to make it clear, we at Capital Squared, we do not approach it this way, but it's a very common approach, is when you think of your portfolio in buckets, right? Or if your assets in buckets. You have a short-term bucket, 6 to 12 months of your expenses. You have your intermediate term bucket, 3 to 4 years of your expenses. Maybe you'll keep it in bonds or something like that. And then you have your long-term bucket. Let's say it's in stocks as an example, that, they call it mental accounting, because when you actually manage someone's portfolio, it works in a different way. But if that helps you, well, that's again one way of thinking about it. Perhaps you would want to organize your portfolio with a specific goal of preserving the principal. And that's important. There are, many ways of doing this. Again, at Capital Squared, we refer to it as creating a, fortress financial plan when you, calculate to be doing it that specific way. But again, you need to think of it ahead of time. The final point is entirely optional, but that's like that mind shift right? So usually, again, when the markets are turbulent, if you're prepared and you keep that, we refer to it as dry powder, on hand, a little bit of excess cash for good buying opportunities, that can actually enhance your plan in the long run. Again, I'll repeat myself, that is optional. I believe a well-structured and well-implemented plan will work just fine without those, opportunities. But if you kind of want to change how you think about it, this is the approach perhaps you would want to take. So with that, again, these are my top 3 for today. There's certainly other mistakes too, but if you can prevent them, I have very little doubt that you'll actually significantly improve the probabilities of a successful retirement.